Hello everyone. I hope so you will be fine. So today we are going to discuss about inventory management, and this is also important, and it is the last topic of working capital management which we are discussing now. So here we go guys. First of all, we need to understand what is the inventory. If you are a, let's assume, retail business, so definitely we keep some goods with us, right, in order to sell to the customer. So that is your inventory. Like inventory is primarily held for sale to the customers, right? So please remember, we know the problem also with the inventory, that if you will keep definitely high level of inventory with you, so you may incur carrying cost, right? Holding cost. So, but if you will keep lower level of inventory with you, definitely then you will also face a problem. Maybe you would not be able to fulfill the customer demand, or maybe you will not be able to meet unexpected spikes in demand, right? Or sometime maybe if your vendor is not supplying you goods on time, so definitely you may run out of stock again. So that this is what is the points. So this is what are explained here. So the additional reasons for carrying inventory include, like, why we hold inventory. So actually the first point is what we want to protect ourselves against what? Against supply uncertainty. As I give you example, let's assume if you are retail business, definitely you are also dependent upon your vendor, right? So if our vendors may have financial difficulties, maybe in the shipment, or maybe the shipment might be delayed due to any other reason, so you may run out of the stock. So that is why we keep inventory level, we keep inventory, right, as a stock, because we want to protect ourselves against supply uncertainty. Second is what, we also need to keep inventory because we want to protect ourselves against what? Fluctuations in demand. Sometime, definitely if you have a season, right? Let's assume you are dealing with ice cream in summer season, so you need to have more inventory, right, in order to meet the customer demand. So this is like a normal trend. Like in season we need inventory, more inventory, but maybe out of season we need less inventory. But sometime there might be a unexpected spikes in demand. Maybe you may get, unexpected customers, right? They are demanding for inventory. So to meet these kind of uncertainty, again, you need to keep the inventory. So as I told you, definitely if you will keep the inventory, so the main point is that maybe you will incur some carrying cost of inventory. Carrying cost means say the holding cost of inventory, right? So that is why being a good manager, so you need to consider why we need to hold inventory, right? So definitely you should not carry unnecessary inventory with you because it will increase your carrying cost. And you should not keep your inventory at a lower level also, because you may run out of your stock also. So this is what we are discussing now, guys. So first thing which I'm going to talk here, that is cost related to inventory. Actually this is one of the objective of inventory management. So being a manager, so we should try to reduce inventory related cost. Now the question is that which cost will be the part of inventory related cost. Okay, so the first cost may include the purchase cost. Okay, so if I will tell you here, so we generally got four types of inventory related cost. First is purchase cost, second is carrying cost, which is also called holding cost, third could be ordering cost, fourth could be stock out cost. So first I'm going to explain how to what is the purchase cost, what it may include, because questions could be theoretical also. And then I'll definitely explain also how to calculate these costs. Then we will see the carrying cost, what it is, then ordering cost, and what is stock out cost. So here we go. So purchase cost. Please remember guys, purchase cost are the actual invoice amounts charged by the supplier. First, this is the first half of the statement. What it means, for example, if I'm buying goods from vendor, let's assume I'm paying $5 for each unit. So actually this is my purchase price. Okay, the price, or this you can say the invoiced amount which I'm going to pay to my supplier. So please remember, the only invoice amount will not be the part of purchase cost. No. So purchase cost will also include the shipping cost. Okay, it means we definitely, for example, if I'm buying goods from, let's assume from another city, so first of all I will pay $5 as a purchase price to my vendor. Then maybe I will incur also what, shipping cost, right? Shipping cost is what, the cost which I will incur to bring the inventory to my present location, right? So those shipping costs will also be the part of purchase cost. So in short, because in exam questions sometimes they may ask theoretical question also, I'll show you as well. So it means that whenever you talk about purchase cost, we should include the invoiced amount, plus we should add what, shipping cost into that. Okay, so then guys, second cost is what, uh, this is okay, if you will add this invoiced amount and shipping cost, so this is also referred to as investment in inventory. So don't forget, so you can say that investment in inventory actually is the alternative word for purchase cost. Okay, so purchase cost include what, invoiced amount plus shipping cost, and invoiced amount plus shipping cost is also called what, investment in inventory. Okay, then the second cost, which is related to the inventory, that is carrying cost. Carrying cost mean to say the cost which we will incur to hold the inventory, right? So generally, it include what? For example, let's assume I have some inventory with me, and that I need to carry. Maybe I need to hold for certain time period. So whatever the cost I will incur to hold that inventory, that is carrying cost. Okay, now here carrying cost includes what? It includes storage cost. For example, maybe I am taking a warehouse on rent, so the rent is like a storage cost, the warehouse rent, so that is going to be the part of carrying cost. Then it may include insurance. Maybe whatever inventory I am keeping in my warehouse, maybe I'm paying insurance for that also. So this insurance is the part of carrying cost. It can also include security, like cost of security. Like for example, maybe I have some security guards over there, right, in my warehouse. I'm paying salary to them, so this is also going to be your carrying cost. Then what? Inventory taxes. If you are paying any tax to hold the inventory, okay, so that is also going to be a carrying cost. It can also include depreciation or rent of facilities. So facilities like a warehouse, the rent of that, as I gave you example, it's a storage cost. And the depreciation, maybe I'm using certain equipment, so okay, to carry the inventory, maybe to keep the record of inventory, or maybe the warehouse itself, if it is owned by me, so the depreciation of warehouse or of equipment will also be the part of carrying cost, because this warehouse or these equipments we need just to maybe deal with the inventory. Then it may include some interest cost in the sense of opportunity cost, because sometimes we invest the money, right? Definitely we invest the money into inventory, but if for example this money, if we would invest somewhere else, so we may have the opportunity to earn some profit, right? But that profit I'm losing now, so you can say it's kind of opportunity cost. So it may include obsolescences and spoilage cost also, right? Sometimes if your inventory is perishable, if it is spoiled, so that is also cost for you, that is going to be the part of carrying cost. And this is what I told you, so all these costs are called what? Inventoriable cost, and simple words, carrying cost. Okay, so please remember, so these words which I am highlighting here, these are really important to tackle your exam questions. Okay, so because in exam they may ask you which cost will be the part of carrying, which cost will be the part of purchase cost, or which cost will be the part of ordering cost. So please make sure you understand these words, and you should know where these words are placed, okay, under which category. Okay, so this is what is generally like when we calculate the carrying cost, so we need average inventory. So average inventory we can calculate this way also. Beginning inventory plus ending inventory divided by 2, right? So calculation I'll explain later. But sometime average inventory can be calculated this way also. Order size. Order size mean to say the number of units which you are ordering one time. For example, one time I'm ordering 2000 units. Okay, so that is order size. So if you will divide with the 2, this will also give you average inventory. So this formula can also work. You need to check in the question which data is given. If order size is given, so then you will take order size divided by 2 to get the average inventory. If beginning and ending inventories are given, so then you can take beginning inventory plus ending inventory divided by 2 to get the average inventory, because this average inventory we will use in calculations later, don't worry. Okay. Okay, then guys, we got third cost here, which is called your ordering cost. Okay, so please remember, what is the ordering cost? Ordering cost are those costs which we will incur to place an order with the vendor. So now generally there is no a clear guideline. So maybe it may include some administration cost, etc. Okay, like whatever cost you are incurring to order, right? Please don't remember shipping cost will be the part of purchase cost. Okay, don't include that here, ordering cost. Okay, and please remember, in exam question, so he may test these 2 points, because sometime, for example, sometime we may manufacture the inventory internally. Maybe we are just manufacturing internally. So please remember, for internally manufactured units, he may give you an exam question, setup cost of the production. He may tell you, okay, setup cost of the production, what it is, where it will fall. So please remember, for internally manufactured unit, setting up a production line is the part of ordering cost. Okay, but if you are acquiring definitely from outside, so then you have to see, actually you have to check which ordering cost you are incurring. Okay, so here please remember this one more point. Sometime the discount lost. Okay, the discount loss, like especially sometime your vendor may give you option that if you will maybe order specific quantity, you may get some discount on the purchase price. But because you are ordering below that specific quantity, for example, specific quantity is 5000 units. If you will order 5000 units, maybe you will get 1% discount. But you are ordering only 1000 units. It means this 1000, it's 1% you are losing. So this is discount lost. Discount lost are another example of an ordering cost. Okay, so discounts are often offered by suppliers for ordering certain quantities. With each order, right, by placing smaller orders, the firm may lose the higher discount percentage. Okay, so this is what is ordering cost. Okay, now the stock out cost. So again, stock out cost, I'll talk in the movement how it can be calculated. But here remember, stock out cost are the opportunity cost of missing a customer order, right? So for example, maybe if customer is visiting you and demands for certain product, but you don't have a product, you are out of stock. So what cost you are incurring of missing a customer order? Maybe it could be a profit foregone. Okay, so that is your opportunity cost. So please remember, this can also include, so one is the opportunity cost. This can also include the cost of expediting a special shipment, maybe necessitated by insufficient inventory on hand. Because sometime maybe you because your stock is out, maybe you will incur some extra cost to get the shipment very quickly. So that extra expediting cost will also be the part of what stock out cost. So that we will see how it will be calculated, don't worry. Now here we have a very small first understanding, and then I'll move to the calculation part, and then I'll explain the questions also, how question would be tested. So it is just a theoretical concept first. Okay, so here we go. They're telling you per unit purchase cost and carrying cost. Sometime in exam question, please remember, as I told you, purchase cost will include purchase price, which is invoiced amount plus shipping cost. Okay, normal shipping cost. So that is your purchase price. Okay, what about carrying cost? Carrying cost in exam question, sometime he may tell you, I'll show you example, don't worry. Sometime he may tell you that carrying cost, which is holding cost, okay, for one unit, he may tell you it is a 20% of purchase price. So whatever purchase price you will get after adding these two, invoiced amount plus shipping cost, so multiply by 20%, this will give you carrying cost. But sometime in exam questions, data might be given this way, and he may ask you to find out carrying cost, which maybe you will use to calculate certain cost later. Okay. So here we go. Let's have a look first here. Okay, so here we go. For example, we have a let's say small data. The following cost data are available for an item of inventory. So first we are provided with invoiced price. Then we are provided with a shipping cost. So invoice price is 300 per unit. Shipping cost is 15 per unit. Then we got some inventory insurance, handling cost, ordering cost, and cost of capital means the opportunity cost. Okay, so now what we have to do? So we have to calculate first purchase price. How would you calculate purchase price? If you remember, I told you in purchase price, you will include these two costs, invoiced amount plus shipping cost. If you will add this 300 plus 15, this is called per unit purchase cost, which is 315. Okay, then what? Please remember this insurance, inventory insurance, okay, is going to be the part of carrying cost. And then we got it here. Okay, then we got it here. Handling cost. Handling cost will not be the part of this of the carrying cost. No. Okay, handling cost because it's not clear here. So this is related to what? Maybe it could be related to maybe loading, unloading, but it's not clear here. Okay, so that's why the question will be very clear. Okay, like which cost is there. So then we got here order cost. Definitely, it's like a ordering cost. Maybe this handling cost will could be the part of ordering, but it's not clear here because it's written here. Okay, okay, it's written here. Yes, it's written. It's per order. Yes, it's per order. Okay, handling cost per order. So definitely it is going to be the part of then ordering cost, right? So then we also got a ordering cost of 15. Okay, these two costs will be the part of ordering now. Okay, handling and ordering cost. So per order cost, if they ask you in the question from this data, for example, so the per order cost is how much it is going to be 95 because 80 plus 15. Then we got it here cost of capital, which is opportunity cost 20%. We know this inventory insurance is the part of carrying cost. I have explained earlier. This cost of capital is also going to be the part of carrying cost. So these first two, invoiced value and shipping cost, is going to be the part of purchase cost. Okay, and this inventory handling and ordering cost is going to be the part of ordering cost. Okay, so now from this question, so if they're asking you what is the purchase cost, so purchase cost will include invoiced amount plus shipping cost. Invoiced amount is 300 given in the question here, plus shipping cost is given 15. So this is per unit purchase cost, okay, which is per unit purchase cost, which is 315. Please remember this cost of capital. This is also take a note, which is your opportunity cost. This cost you will always multiply with the purchase cost per unit, okay? With the purchase cost, always will multiply with the purchase cost. So that's why I'm going to multiply now this opportunity cost, okay, or the cost of capital, which is how much is 20% in the question. So if I will just multiply, guys, just wait a second, please. Okay, so guys, then we will multiply with the opportunity cost, which is 20%. So this is going to be $63 as carrying cost, okay? But there is another carrying cost, which is inventory insurance, which is $5 here, right? So that I will also add insurance, which is $5. So total is going to be $68, which is my carrying cost, right? So two things we have calculated. So the first one, what is the purchase cost, which we need in calculation later. So that is the purchase cost. Second thing we have calculated, what is the carrying cost, that is 16, which includes opportunity cost, insurance cost. If you are provided with the spoilage, warehouse rent, those things you can also add. Okay, and third thing, if they ask you what is the ordering cost, then you will add these two costs, 80 plus order cost. Okay, 15, so total is 95. Understood? Okay, I hope so it is clear. Now, guys, From here, let's move to the calculation now. As I told you, we got four types of cost related to inventory. So first is how to calculate, because our as a manager, our objective is to minimize inventory related cost. Okay, and inventory related cost, first cost is, and these costs we can calculate in annual terms. Okay, for example, per annum terms. And inventory related cost are four inventory related costs are there. Okay, the first one is what? The purchase cost in annual terms. Okay, so then second one is what? Carrying cost. And the third is what? Ordering cost. This is what a formula I'm going to explain now. And the fourth is what? Stock out cost. Stock out cost I'll explain at the end. So first I'm just going to move to these three. Okay, purchase cost, how to calculate; carrying cost, which is also called holding cost; and ordering cost. Okay, stock out cost we'll see at the end of the lecture, and then I'll show you questions as well. So guys, please remember purchase cost. This is how you will calculate. This is the formula. First of all, because we are calculating in annual terms, so annual purchase cost, how you will calculate. Don't worry if you are provided data for 6 months, so you can use the 6 month data also. But if you are provided with the annual data, you can calculate for annual also. So annual purchase cost, how would you calculate? First of all, you need annual demand in units. He will tell you in the question. It will be given definitely. Okay, and multiply by purchase cost per unit. And do you remember purchase cost per unit includes what? Invoiced amount plus shipping cost. Okay, so if you will multiply annual demand with purchase cost per unit, so if you will multiply these two things, so this will be your annual purchase cost. Okay, don't forget, it's very easy formula. You can just read it by yourself one time, so how it will be calculated. So annual demand times purchase cost per unit. Okay, now here we got how to calculate holding cost, which is also called carrying cost. Okay, carrying cost. So how you will calculate holding cost? So this is the formula for that. Average stock. First you need average stock. Do you remember for average stock I told you two formula? First formula is what? You can take order size divided by 2 to get average stock. There is another formula, opening inventory, opening stock plus ending inventory means a closing stock, and divide with the 2. This is also average stock. Okay, so you have to check the question, order size is given or opening or ending inventory is given. So both ways will work. Okay, so definitely if this data is given, use this one. If order size is given, if opening and ending inventory is given, then use this one to find out average stock. And this average stock we will multiply with holding cost per unit per annum. Most probably it will be given. If it is not given, so then he may tell you this way, that holding cost per unit per annum is, let's assume, 20% of purchase cost. So purchase, first you need to know purchase cost per unit. Okay, whatever purchase cost per unit, purchase cost per unit include invoiced amount plus shipping cost, right? So you need per unit invoiced amount and shipping cost. Put it here. Okay, this will give you purchase cost and then multiply with 20%. So this is how you will get holding cost per unit per annum. Okay, one more thing here. Sometime in your exam question, he may add here one extra information. What could be that? So that is possibility. The possibility is for safety stock. You know this word, remember this word, safety stock. Okay, what is safety stock? Actually, safety stock is the minimum inventory which we keep in order to avoid the stock out. For example, you are running a business, you are keeping 150 units all the time with you to avoid stock out. Okay, this is the minimum level of inventory which you always keep. This is called safety stock. So in exam question, if I'll write this formula. Okay, so holding cost, how would you calculate? So there are two possibilities now. if there is no safety stock. If no safety stock is provided, if we don't have a safety stock, then how would you calculate carrying cost or holding cost? You need average inventory, which I told you will calculate this way, either order size divided by 2 or opening inventory plus closing inventory, which is ending inventory, divided by 2. Okay, so we need average inventory and multiply by cost of holding 1 unit per annum. Okay, or carrying cost per unit per annum, or holding cost per unit per annum, any word you can use. Okay, holding cost per unit per annum. Okay, this is the one formula, and here we don't have a safety stock. And please remember, if safety stock is given, now I'm just assuming if safety stock is given, so then what, how would you amend this formula? If safety stock is provided, now just I'm removing this. If safety stock is provided, now it's provided. So what you will do with this average inventory, you will add here safety stock also. Please, or if I will just write it here, let me remove because you should not confuse it. So this is what this case was there. If no safety stock is given, this is how carrying cost you will calculate. But if safety stock is given now, if safety stock is given, then what? How you will calculate carrying cost? This is how you will calculate. Carrying cost per annum will be equal to average inventory, and average inventory, I told you, this is how you will calculate order size divided by 2 or opening plus ending stock divided by 2, whatever way is given. So average inventory, with this average inventory you will add here safety stock. Please don't take the average of safety. Okay, just safety stock, whatever is given, just write it, safety stock. Okay, add these two and now multiply by this with this holding cost per unit per annum. So if you will just multiply this thing, okay, so you will get carrying cost. Okay, I hope so it is clear. So then guys, we got it here, ordering cost. Okay, ordering cost is what, how you will calculate ordering cost. For ordering cost, this is the formula. Again, ordering cost we are calculating in per annum term. So we need how to calculate ordering cost. Now we need first number of orders in a year, number of orders multiply by cost per order. Okay, cost per order, cost per order will be given in the question. Okay, but number of orders you need to calculate. Number of orders, this is how you will calculate, annual demand divided by order size. Order size means how many units you are placing in one order. Okay, so that is annual order size. So if you will take annual demand divided by order size, this will give you number of orders in a year times cost per order, which will be given. So this, if you will multiply these two figures, you will get annual ordering cost. Okay, is that clear? So these three formulas I have explained: how to calculate the purchase cost, how to calculate the carrying cost, how to calculate the ordering cost. Right now, just I'm going to tell you here one extra thing. Please remember, for this, calculations are not required for CMA exam, for CMA specifically, but we need to understand what it is because theoretically questions they can ask. So, but I'll explain the calculation also, but it is not required for your exam. So first, determining the order quantity. Okay, there is a one approach which is called EOQ approach. EOQ stand for economic order quantity. Okay. Okay, if you will use this approach, actually this, what this EOQ, it will actually help you to calculate order size. Calculate order size. Order size means, say, this EOQ formula will give you answer of how many units we should order to vendor one time. Like one time, how many units we should order with the supplier. Okay, that is EOQ. So it will. That's why I told you it will give you order size. And how to calculate this order size by using EOQ. And what is the beauty of this EOQ? In this EOQ, uh, what will happen? Two things will happen. Okay, first scenario I'm explaining here. First scenario. Scenario number one is what? First scenario is what? Your ordering cost, I told you ordering cost formula previously, right? Number of orders times per order cost. It will be equal to the carrying cost. Do you remember for carrying cost formula? Carrying cost formula is average inventory multiplied by holding cost per unit per annum, right? So these two things will equate actually. But assumption is that if you don't have a buffer stock, safety stock is also called buffer stock. If you don't have a safety stock, then ordering cost will be equal to carrying cost. And now the point is why this EOQ is important for us actually, right? Like if you will think normally in your life, so what happening? If you increase the order size, for example, if you increase the order size, this is what I'm writing here. Like let's assume this is order size, and now here I'm explaining the impact of order size on carrying cost and ordering cost. Okay, if you will increase the order size, what will happen? Your ordering cost will be less because you are placing more number of units in one order. Ordering cost will be less. Maybe in a year you will order very few orders. You will place very few orders. That's why ordering cost will be less. But carrying cost will increase. This will happen, right? Practically. And now other scenario. Let's remove this. Okay, what if you will reduce the order size? For example, you are going to place maybe 5 units only in one order. What will happen? Carrying cost will reduce. Carrying cost, maybe you because you don't carry inventory, but ordering cost will increase because you need to place order again and again, again and again. This is the problem practically, right? So to solve this problem, EOQ approach was introduced. They're saying that okay, so this problem is solved if you will calculate the order size by using EOQ, whatever answer EOQ will provide you. Okay, so there what will happen? Ordering cost will equate carrying cost. But assumption is that we don't have a safety stock. If you are keeping safety stock, that's why definitely then carrying cost will be more, ordering cost will be less. But if you don't have safety stock, your ordering cost will be equated to the carrying cost. Okay, now the question is that, so how to calculate the EOQ, like order size by using EOQ formula, how to calculate? Okay, this is the formula for that. 2 times A times D divided by K under root. Okay, so if you will solve this, so this will give you order size. Now question is that what is, or I can write this way also, 2 is the standard of the formula. Okay, there is no logic for that, just 2 is the standard times A. What is A? A stand for per order cost. Per order cost. Okay, like how much cost you are paying at one time. Then this D stand for annual demand. Annual demand. Okay. So then divided by what is K? K divided by K. K stand for per unit holding cost per annum. Holding cost per annum. Like that we can call it holding cost per unit per annum also. And then if you will take under root of that, so this will give you Q stand for order size or EOQ. Okay, economic order quantity. Why it's called economic order? Because it is economical for you because it will equate your ordering cost with the carrying cost. Okay, but provided that you don't have a buffer stock. Okay, so this is what is the EOQ formula. So don't forget this formula. So in exam question, what they can ask you from the formula, they may ask you, okay, which components are going to be the part of EOQ formula? You should know it is per order cost, annual demand, and holding cost per unit per annum. So these are the components of the formula. Okay, and if they will ask you what is the benefit of EOQ, you would say if we don't have a buffer stock, then ordering cost will be equal to the carrying cost. Okay. Now, this is what is the note. Please remember for your CMA exam, CMA candidates should have an understanding of EOQ model. Okay, that we discussed for inventory and how a change in one variable would affect the other, will affect the order quantity. Like what it means. See, this is the formula in front of you, right? Okay, we know in the formulas we got some numerators, right? This side numerators, and we got some denominators, the below side of the formula. If numerator will increase, definitely Q will increase, EOQ will increase. If denominator will increase, definitely Q will decrease, right? Or if the denominator will decrease, this Q will increase. So this is what they're trying to tell you. This is what the question they may ask. I'm not sure you understood or not. So let's have a look. Let me explain slowly. For example, what if I'll if this per order cost I'm discussing first, okay? Let me change the color. If per order cost is increased, so what do you think? EOQ will increase or decrease? It will also increase. If per order cost is decreased, EOQ will also decrease because numerator has direct effect with the EOQ. If annual demand will increase, EOQ will increase. If annual demand will decrease, EOQ will decrease. But what will happen if per unit holding cost will change? This is the denominator. If the holding cost per unit will increase, so the Q should decrease, right? Opposite direction now. If holding cost per unit will decrease, so Q will increase, right? So I hope so it is clear, right? This is what they're saying as a student. This is what they can test in your exam from this formula, that how the changes in the components of the formula will affect your order size. Okay. And then the next question they may ask you, here it is defined also, that thing, whatever I'm telling you. So this is change in variables. There are variables like ordering cost, annual demand, and and holding cost per unit per annum. And this is what is the order quantity, which is EOQ. So it is written here, if demand will increase, order quantity will increase. You can reverse it. If demand will decrease, order quantity will decrease also. So it has direct relation, right? If one increases, second increases. If one decreases, second decreases as well. Order cost. Okay, if order cost will increase, order quantity will increase. What if order cost will decrease, order quantity will decrease also? Again, direct relation. But carrying cost is the denominator in the formula. It has inverse relation. If carrying cost will increase, order quantity will decrease. If carrying cost will decrease, order quantity will increase. Okay, this is what the question, this is what is written in the note, that these things they ask. And second thing from the EOQ, which they ask you, that is assumptions of EOQ model. Like, what are the assumptions? Okay, so let's understand. First of all, in EOQ formula we have used 2 times per order cost. We also used annual demand divided by holding cost per unit per annum, holding cost per unit per annum, right? This is what is a component and under root. Okay, so now here we go. So what are the assumptions of EOQ? So you should remember, first of all, we assume that we can predict the demand with certainty, that this demand is known, first assumption. Second is what? Carrying cost are constant, like this denominator. We say that this will not change. It is constant, okay? Constant, it will not change, or definitely in the short run, not in the long period, okay? Then what? The same quantity is ordered at each reorder point, like, because when we get the q here, EOQ quantity, definitely we will order every time this q, we will order whatever we will get, okay? We will not change it. Next is what? Purchase cost are unaffected by quantity ordered. It means we ignore the quantity discount here, and or we assume there is no quantity discount, we can say this way as well, okay? We ignore the quantity discount, or we can say there is no quantity discount. So that's why, because if discount is there, so then q, maybe you will order different, right? Because you want to get the discount, then your order size may change. But here we assume we don't have a discount, or the discount will not affect our order size anyway, you can say. Then sales are perfectly predictable. This is what is annual demand. Yes, because sales is equal to demand, so we can predict with certainty. Then lead time is known. Lead time, I hope so you have idea. It's a time, between when we place the order and when we receive the goods. The difference between these 2 points is lead time, and we can predict the lead time with certainty also. Then deliveries are consistent. Yes, there is no delays in the delivery, etc. Whenever we will order, we will get within the lead time. Okay. Then adequate inventory is maintained to avoid stock out. For example, it means like you may have some safety stock also. Okay. Then this is what I have already explained now. There's a one more note. Let's have a look. They're saying CMA exam periodically includes question in which beginning and ending inventory are not known. Okay, but here we go. How? Because question definitely I'm going to show you. So here we got one example here. So this is one example, guys. Then I'll move to the stock out and then main question. So here we go. Let's have a look to this example. Need concentration, please. Okay, they're saying that. Okay, guys, so one thing I want to clarify here also, please remember in certain books, this thing is written in different way. Like in this book, what's written here, it's written as, for EOQ, it's written as what? 2 times A times D divided by K. Maybe in your books, it might be written 2 times maybe O times D divided by C. Anything. It's just a denotation difference, but this is the pure concept. Pure concept is you need to, you need per order cost. So per order cost can be denoted with A, B, C, whatever word you want to use, you can use it. But the main word is 2 times per order cost. And then we need annual demand. Demand you can denote with the D or even Z, whatever word you want to use, but it should be annual demand divided by per unit holding cost per annum. It can be denoted with anything. Here it is denoted with K. In certain books, it's denoted with H. In certain books, it's denoted with C. But this is the concept. Okay, like 2 times per order cost times annual demand divided by per unit holding cost per annum. That's it. So now, guys, we got a question here. This kind of question may appear in your exam as well. So it's bit a long question. I just want to discuss here. In size, it's small, but in concept, it's good. So they're saying a mulch wholesaler has offered a home and garden company a year-end special purchase. Okay, year-end special purchase is there, whereby it could purchase 30,000 bags of mulch at $3 a bag. Okay, this is like a quantity. Okay, they give you kind of, incentive. Okay, you can place the order of 30,000 bags and pay the price $3 only. But the company normally orders 5,000 bags of mulch per month at 4.5. Okay, they're saying company generally they buy 5,000 bags, okay, and they pay the price of 4.5. This is normal practice of the company. But now they're saying if the company will order 30,000 units at a time, so they can pay $3 per bag only instead of 4.5. It's kind of discount, right? Okay. It means if you will place order of 30,000, you will pay $3 per bag. If you will order normally 5,000, you will pay $4.5. It's kind of discount, okay? They're saying that but you have to focus on the question, because I'm not going to explain the discount versus EOQ because it's not in our syllabus. Okay, but here question is different actually that I'm going to answer. They're saying that a company's cost of capital is 8%. Okay, then they're saying in calculating cost of capital 8% means what? I told you already, it's opportunity cost, right? Because when we invest into the inventory, so you are losing the opportunity to earn profit by not investing in some other investment option, right? So that's what's opportunity cost. So they're saying in calculating the overall opportunity cost of this offer. Okay, actually you have to calculate opportunity cost of this offer. What is the offer? This is normal practice. Like you order 5,000 bags and you pay 4.5 per month. 5,000 per month you are ordering. Okay, and now if you will order now, this is special offer. Now if you will order 30,000, you will pay 3. And they're saying that if you will go with this offer, like if you will buy 30,000 to get discounted price, so what is the opportunity cost? This is the question actually. Okay, this is the question actually. So like if you will move from normal routine from 5,000 to 30,000 order bag, okay, order units, so then what is the opportunity cost for you? So this is what is the question. They're saying that, again, I'm reading requirement. They're saying calculating the overall opportunity cost of this offer. Okay, the cost of carrying the increased inventory would be, okay, because if this is actually the question, this is actually question that what will be the cost of carrying increased inventory. So what it means, like normally you order 5,000 units, but now you are going to order 30,000 units. Definitely your inventory will increase. If inventory will increase, the question was not about opportunity cost actually, guys. The question is about if inventory will increase, so what will be your increase, what will be the increase in carrying cost? due to this shift from 5,000 to 30,000. It means we need to know now, okay, cost under both option, like what was the cost here and what is the cost here, and definitely the difference in cost will be due to increase in inventory, right? This is what we need to do now. So here we go. Okay, so here they're saying that first of all, let's break down the scenario. Now, first of all, I'm just talking about the current purchasing pattern. You know, current purchasing pattern was what? Current purchasing pattern was we were normally ordering 5,000 bags and we were paying 4.5. Okay, let's do it now. So it means monthly, the cost of mulch was what? We were ordering 5,000 bags times 4.5. So it was 22,500 only, right? Which we were investing in every month. Okay, so then if you want to calculate, because we want to calculate now average inventory cost, right? So it means average inventory, how you calculate? Order size divided by 2, because you are not provided here with the opening inventory and you are not provided with the here ending inventory, so divide by 2. So this formula you cannot use, you have to use this order size. Order size is given here because normally we order 5,000 bags, so we can calculate the average inventory, right? Okay, so 5,000 bags, okay, uh, multiply by 4.5, which is the purchase cost, and divided by 2. Okay, this will give you average of how much average investment, like on average this was your investment in inventory, right? Like 5,000 multiplied by 4.5. Okay, 5,000 multiplied by 4.5 divided by 2. Okay, so this will give you average investment in inventory. So 5,000 times 4.5 is 22,500 divided by 2. So 11,250 was your average investment. Okay, maybe you are thinking, okay, maybe you are thinking that we are required to calculate carrying cost. Okay, carrying cost should be equal to average inventory multiply by multiply by okay, multiply by what? Carrying cost per unit per annum. Okay, so but here we are not provided with the carrying cost per unit per annum. Okay, so or you can do this way. First, carrying cost per unit per annum is not provided because we just want to calculate the carrying cost of increased inventory. So here we are provided one hint, that is opportunity cost, right? Opportunity cost we are provided here. So what we will do, so we need to first calculate the average inventory here. Average, and average inventory we can calculate this way because I'm just talking about in figures. So average inventory, how you will calculate? Order size, which is 5,000. Okay, multiply by 4.5. Why I'm multiplying with the 4.5? Because I'm just directly taking into dollars figure, that's it. This is the difference actually. Okay, so then divided by what? 2. So you will get 11,250 is the average inventory. So this portion just we got. Just wait a second. Okay, 11,250. Okay, then what? Okay, so average inventory just I got. Okay, because I want to calculate first increased inventory. Then what? At the end, at the end. Okay, I'll multiply with this opportunity cost at the end. So first I'm telling you average inventory under old option. There are different ways to solve it. Okay, I'm using simple way. First, average inventory under old option. So average inventory under old option is 11,250. Now we have to work again average inventory, okay, under new option. And under new option, order size is how much? 30,000 bags and price is $3. Okay, so let's have a look. Order size, which is 30,000 times $3, which will give you answer in actually dollars, divided by what? 2. This will give you average. Okay, average is going to be how much, guys? If you will just take average is going to be 45,000, right? Because how? 30,000 times 3 divided by 2. So okay, you got average inventory under new option $45,000. Okay, dollar. Then what? Now you have to check what is the increased under existing option. It was only 11,250, which we calculated this way: 5,000 times 4.5 divided by 2, and under new option it is 45,000. Okay, so now tell me how much increase in inventory average. On average, how much is the increase in inventory? So this is how you will calculate. Increase in inventory is this incremental inventory investment. Incremental inventory investment. As I told you, there are several ways to solve it. Okay, so but I'm using the simplest way. So incremental inventory investment is what? Under new option, it is 45,000 average. Under old option, it was 11,250. So incremental is how much? 3,300 and 750. So now I'll come back here. Okay, because the question was what you have to calculate carrying cost. For that we need average inventory, but now actually we need increase in average inventory due to this option and multiply by opportunity cost, which I'm assuming by carrying cost. Okay, so increased in average inventory is what? 33,750, which we got this way. 45,000 under new option, 11,250 under old option. This increase in inventory, right? And multiply by opportunity cost, which is given as 8% in the question. So just multiply. So this will give you carrying cost of increased inventory. So just take the multiply 33,750 times 8%. So can you just take it? Okay. Now here. So if you will just take it, but still we need to get again average of this. Okay. This is one more thing. Still we need to get the average of this. Average of this. Don't simply multiply here with straight away. Just still we need average inventory of this, because this increased in average inventory. Again, we got first inventory under old option, we got here under old this one and under new this one, and now the difference is increase in inventory. Again we need to average this increase in inventory. Okay, again don't take straight away difference. Again we need to take average of this. So 33,750 divided by 2 and multiply by 8%. So this will give you, because we are calculating average increase in inventory. Increase in inventory, okay? Like what will be the average increase in inventory? So that is, this is the increase in inventory. 33,750 divided by 2 will give you average increase in inventory. Multiply by 8%. So this will give you what? How much cost? 1350, I think so. If you can just confirm 1350, yes. Okay. Okay, so this was the one way, guys. Just I hope so it is clear. Okay, guys, I hope so it is clear. This is how, like, it was, I know the exact question, but you can just practice one more time. Okay, example is in front of you. Because the question was what? It was about how to calculate the cost of carrying in the increased inventory. Okay, and I'm just quickly refreshing. I have already explained these things. These are the key takeaways from this discussion. So first of all, special purchase lowers the unit cost of mulch. Yes, like if you will order 30,000 units, so your purchase cost will reduce from 4.5 to 3. However, it increases the company's average investment, definitely, because previously you were ordering only 5,000 units. Okay, at 4.5, now you will order 30,000 units at 3. So definitely the difference will be increase in your inventory. So this is what they're saying, that increase in investment. So then opportunity cost, the cost of capital tied up in extra inventory. Definitely, if you will invest more, so your fund will be stuck in the inventory. So this is creating opportunity cost for you, and which was 1350. Okay, so the calculation helps the company assess whether the bulk purchase saving outweigh the carrying cost. Okay, so this is what we have actually understood. Okay, now guys, about safety stock, and then I'll move to the question. That questions will help you to understand, okay, how in exam it will be tested. Okay, this was just a discussion. So here we go, safety stock now. So guys, if you look at here, safety stock, as I told you, it's also called buffer stock. Actually, it is a level of extra stock held to protect against risk of stock out. Like we don't want stock out actually, right? So to avoid stock out, so we keep some extra stock with us, that is safety stock or buffer stock. Then they're saying maintaining safety stock increase carrying cost. Definitely, if you will keep buffer stock with you, so your carrying cost will increase, as I told you earlier. So here we go. Then this is just a reading, and then I'll tell you actually how to work with it. Don't worry. So, determining the appropriate level of safety stock involves balancing the variability of customer demand, variability in lead time, and level of risk of stock out the firm is willing to accept. Actually, they're saying that how much safety stock you have to keep, it depends upon variability of customer demand. It depends upon also variability in lead time, that how much time uh, you know uh, can fluctuate in receiving the goods, and the risk of stock out also. Okay, so this will help you to decide, but I'll explain with the calculation, don't worry. So this is like a normal graph like this. If this is vertically, if you got a cost of inventories or inventory related cost, and if horizontally you got a order quantity, means the units. We know we know what, if you will move from this to this side, it means your order quantity or units has increased. If you will move from here to here, it means your cost is increasing, right? Okay, now look at here, what is the point here? Okay, so the point is here, guys. Here we go. If you will look at here, ordering cost. Definitely, if you will increase your order size, if you will move from left to right, it means your order quantity is increasing. Definitely, ordering cost will reduce. Why reducing? Because we assume ordering cost is fixed. Okay, if you will place a few orders with big quantity, definitely your ordering cost will reduce, right? Because we assume ordering cost per order is fixed. Okay, then what second? If you look at here, this is your carrying cost. Definitely, if you will increase the order size, so your carrying cost will increase as your order size will increase. Okay, and then the third, we assume purchase cost is constant. Okay, we assume we don't have, let's assume, discount. Okay, purchase cost is constant, it will not change, right? So now the point is, this is the point where these two lines intersect across each others. Which two lines? Especially this ordering cost line and this carrying cost line, where they cross each other. This is actually EOQ point. Okay, you have to check what's the quantity here. Here your ordering cost will be equal to the carrying cost. Okay, this is the normal graph. Now here the question is, these 3 points are important, may be tested in your exam theoretically also. They're saying following relationship exists. Number one, stock out cost can be minimized only by incurring high carrying cost. Yes, because if you will keep more buffer stock, so carrying cost will increase, right? Definitely stock out cost can be minimized then, because there will be a less chance that your stock will be out. Then they're saying carrying cost can be minimized only if you want to minimize carrying cost. So by incurring high fixed cost of placing many small orders. This is also true. I told you ordering cost and carrying cost. I told you if you will increase the order size, carrying cost will increase, right? If you will decrease the order size, carrying cost will decrease. This is what they're saying. Like if you want to decrease the carrying cost, you need to place small orders, many orders, okay? But with small quantity. Third, ordering cost can be minimized. Okay, if I want to minimize ordering cost, then what I have to do? If we want to minimize the ordering cost, so only at a cost of storing large quantity. Yes, because if I want to minimize my ordering cost, it means I need to increase size order size I need to increase, like more units I should order. But if I will order more units, my carrying cost will increase, but ordering cost will decrease, right? Because you have to think na, if you will place order with big quantity, maybe you will place very few orders in a year, so ordering cost will decrease, but on the other hand, carrying cost will increase. This is what they are saying. Now we have a question here. Let me tell you. First, I'll explain here. In exam questions, sometime he may tell you the cost of carrying a safety stock. Safety stock. Okay, what we are calculating? Cost of carrying a safety stock. In exam, sometime he will give you this equation. So they're saying in exam he will actually mention it. Okay, so cost of carrying safety stock. Please don't think this way only. Okay, like if you will carry a buffer stock, so you will incur holding cost only. No, so they're saying the cost of carrying safety stock. Like if you will carry different level of safety stock, so it is equal to expected stock out cost plus carrying cost. Carrying cost to keep the safety, but expected stock out cost also. Stock out is what? For example, definitely if you will keep lower safety stock, so there are more chances for stock out. If you will keep high safety stock, there is less chance for the expected stock out, right? Definitely carrying cost you will incur, whatever you are holding cost you are paying, that you will incur. But stock out cost will also depended upon safety stock. Okay, if in exam, if he wrote this equation, don't make it difficult, guys. I'll explain the process now and then I'll do the question and then you will understand how it will work. Okay. So if in exam question he stated that you have to calculate cost of carrying safety stock. So you have to consider these two costs, expected stock out cost if given. If given, you have to calculate this one also. If not given, then only you will take carrying cost. But if expected stock out cost is given, you will take that also plus carrying cost also. Okay. To find out cost of carrying safety stock. Okay, if you are confused, let me show you with the help of example. Okay, in exam, he will give you data like that, and I'll tell you from this data what will be given and what you have to work. In exam, he will tell you this way. For example, he will tell you there is a company, prepare the following schedule of likelihood of stock out, like how much chance is there for the stock out at various level of safety stock. Okay, he will tell you different safety stocks also for upcoming year. Actually, this data will be given in the question safety stock level. Like what if you will keep 200 units, 100 units or 0 unit. He will tell you where I'm putting G means it will be given in the question. It will be given. Resulting stock out, it will also be given. Okay. Probability will also be given. But this you need to calculate. Okay. For example, in exam, he told you the companies having are planning to keep these three safety stock. What if they will keep 200 safety stock? So resulting stock out would be zero. He will tell in the question. What if what if they will keep 100 units as a safety stock? Resulting stock out is 100 units. Okay. Maybe the demand is 200 units actually. Let's assume this way. So if you will keep 200 safety stock, unexpected demand. Okay, unexpected demand 200 units. If you will keep 200 safety stock, there is no stock out. But if you will keep only 100, so then there is a chance of 100 unit stock out because demand is like, let's assume unexpected demand is 200. Okay. Then if you will keep for example zero safety stock, for example, then for example again resulting stock out is 100 for example. But here the question is not clear. I'll show you question later because this is just example. They assume the data and they solved it, that's it. Okay, but I'll show you question also, but this is just process I'm explaining. Okay, so assume this way. This, don't think why this data is given, think this way that this data is available and how you will work with that. Okay, so we got safety stock level at 2. If you will keep 200 units, 0 stock out, 100 units, 100 stock out, and 0 unit, 100 stock out, because here probabilities are attached. Okay, for the first outcome or for these two outcomes. Okay, because probability is attached. Okay, probability that what if they will keep 200 units, resulting stock out is 0, so probability for that is 10%. What if they will keep 100 stock out, 100 units, there is a chance for 100 unit stock out, probability is 20%. And what if they will keep 0 safety stock, so the resulting stock out could be 100 and resulting probability is 15%. So this three will be given. Okay, just assume this data is given because I'm trying to create a logic from here, but because their probabilities are actually attached. Okay, so then what you will do? So this is given, this is given, this is given. So what you have to do? This you need to calculate expected stock out. How you will calculate? You will multiply this stock out with this probability. I hope so you have idea about expected value. So like 0 times 10, it is 0. Then 100 times 20, it is 20. Then 100 times 15, it is 15. Okay, so you got expected stock out at three various safety stock level. Okay, now what? Again, what you will do in the next step, because same steps you will follow in calculations also. Okay, in the next step, what you will do? You will bring this column down first, safety stock level, and then second column you will bring down this one. At safety stock level of 200, expected stock out is 0. At safety stock of 100, okay, expected stock out is 20. At safety stock of 0, expected stock out is 15. So these two columns you will bring out, and then you will multiply with the unit cost here. Okay, because this is expected stock out multiplied by unit cost. Because one time cost is 3.50, for example. Unit cost will be given in the question. You don't need to assume. Okay, so it will be given. So we need expected stock out with unit cost. For example, expected stock out is 0 units times 350. Okay, so this will give you cost of stock out 1 unit if you will multiply, and then you will multiply the answer of these two column. Like once you will multiply expected stock out with the unit cost of stock out, so this is like cost of stock out one time. If you will multiply cost of stock out one time, and then you will multiply with the orders per year, like number of orders in a year, so then this will give you yearly cost. Okay, for example, okay, for example, 0 times 3.5 times 18. So this will give you expected stock out cost of year, which is 0. 20 times 3.50, this is one time stock out cost. If you will multiply and then multiply by number of times or number of orders in a year or number of times stock out in a year, so this will give you yearly cost. Then 15 times 350, this is one time stock out cost. Then multiply by times in a year or number of orders in a year, you will get yearly cost. Okay, so you got here expected stock out cost, you got it here. Now this column is important for you, this column. Okay, now third, what you will do? Third, you are going to again bring this column down, safety stock level, and now second column you this is important. Actually, this is important because with this expected stock out cost, you need to add carrying cost. So this will give you cost of safety stock. So expected stock out cost you have already calculated. Okay, now you have to calculate what carrying cost. What if you will bring first, you will bring this safety stock level 200, 100. Okay, then multiply by unit carrying cost will also be given. This as unit stock out cost will be given, this unit carrying cost will also be given. So now, if you will carry 200 times 4, because this is 200 units you are carrying, $4 is the carrying cost per unit. This is total carrying cost 800. Okay, then if you will keep 100 safety stock per unit, carrying cost is 4, so 400 is carrying cost. And if you will keep 0 safety stock per unit is 4, so it will be 0. Now what, at the end, so this carrying cost you will add with this expected stock out cost. Okay, last step I'm doing now, and I'll repeat the same step with the question again. Okay, what now? Again, you will bring the safety stock level down, safety stock level 200, 100, 100, and expected stock out cost we have calculated here. This we will bring now 0, 1, 2, 6, 0, 9, 45, and carrying cost we have calculated here in the next step. This I'll bring it here. Now expected stock out cost plus total carrying cost. This is total cost of safety stock. For example, 0 plus 800, 800. 1260 plus 400, 1660. 945 plus 0, 945. Okay. Okay. This is how you will calculate total cost of safety stock, which is equal expected stock out cost plus total carrying cost. This is what I was saying here. Like total expected stock out cost plus carrying cost equals cost of carrying safety stock. This is what equation we did. And let me show you question now. I'll show you first direct question related to that because you should not be confused how question will be tested. Okay. Okay. So here we go. We got a question here. For example, its question is a bit long, but let's do it. I'll take this data to that format. Okay. And you will understand easily. Okay. So the question is they're saying controller at a chain of hardware stores wants to determine the optimum safety stock level for for an air purifier unit. Optimal safety stock level definitely where maybe our cost will be minimized. Okay, from cost point of view. So the inventory manager complied the following data. So I will highlight important data, only highlight. Annual carrying cost of inventory approximate 20% of investment in inventory. Investment in inventory means a purchase price, purchase cost plus shipping cost. This is investment in inventory, right? 20% of that is carrying cost. So highlighted figure is what? Carrying cost of inventory is 20. This is important. Then inventory investment per unit. This is like purchase price, purchase cost. As I told you, purchase cost plus shipping cost is called investment in inventory, and investment in inventory is given. This is purchase cost. This is actually purchase cost is given. Okay. And this is carrying cost is given in percentage 20%. Okay. Can you calculate carrying cost? Carrying cost will be $50 times 20%. And it is going to be because purchase price times 20%, it is going to be $10. Just we took first information. Okay. So carrying cost is $10. Don't forget now. Okay. Because I'll move to the above format. Carrying cost is $10 per unit per annum. Then stock out cost is also given $5 per unit. It's $5 per unit. Okay. So one more information is given. I will just take it there on the above format because there I'll change the things now. So we got carrying cost 10. We got stock out cost 5. I'll write it there just as a reference. I'm going to the above format where we have done. Let me remove this, all this because I'll follow the same format so it will be easy for you to understand how it is solved. Let's remove this. Okay. Just I'm writing here as a information. So what he told you, we got expected per unit, expected stock out cost $5 and carrying cost $10. These figures we have calculated. Okay, just I'm writing here. Okay. Okay. So this should be a cost of carrying safety stock, but I need to follow this process, right? With probabilities, etc. Okay, now move to the next point. They're saying companies orders inventory on average 10 times per year. Okay, 10 times per year. You know what is this information? This is this information actually. How many times you order in 1 year? Order per year is 10 times. Just writing here. Okay, orders per year is 10 times. Okay, third information. Then moving to the question again. Okay, then total carrying cost is carrying cost. Total cost equals carrying cost plus expected stock out cost. This is the equation he told you. Which equation? This equation. This equation he told you. This equation. Equation he told you. Okay, total cost, say, cost of carrying cost is expected stock out cost and carrying cost. Okay. Then what? Then what? Probabilities of stock out per order cycle with varying levels of safety stocks are follows. As follows, here we given safety stock level 200 units, 100 units, 0, 0. This is resulting stock outs. This is probability. Okay, so do you know which information it is given? Actually, this is the first three things are given. Safety stock levels are given, resulting stock out is given, and probability is given. Okay, now I'll move to the question. What's the question? They're saying the total cost of safety stock we have to calculate, right? Which is equal to uh, stock out cost plus carrying cost of safety. So this will be equal to this figure, okay? On annual basis with the safety stock level of 100 units. See, here we have different units level 200, 100, 0, 0. So they're saying that you don't need to work with all because it's not an essay question. It's just MCQ's question. So they're saying use this level. If you keep 100, this data you have to use only. That's it. Okay. At this is an at 100 units level of safety stock. So you have to calculate the cost of carrying safety stock. Okay. So don't forget at safety level, safety stock level is 100, resulting stock out is 100, and this is probability is 15. So let's go there now. I'm following the format now. Okay. We'll start from here. And now what? We got 100 safety stock level, first column. We got resulting stock out is also 100. And the probability is not 20 now. Probability is 15%, right? Because just I want to solve this row only. The data was what? Safety stock level is 100. Resulting stock out is also 100, right? Just cross check. Yeah, safety stock is 100. Resulting stock out is 100. Probability is 15%. Okay. Step number one, we will do this. Safety stock level 100, resulting stock out 100, and probability is 15. So this should be now 15 expected stock out, right? Okay. Now what? Second step. This safety stock, I'll bring it here. This 100. Ignore this. Okay, times. Ignore this also. This also. This is not a 20. This is going to be 15. I'll place it 15 here. So 100 times 15, it will be, okay, not times, just I'll write 15 and then I'll multiply with the unit purchase cost. And unit purchase cost is, go to the question. Unit purchase cost is 50. 50. This is investment per unit, which is 50. Okay, multiply with the 50. Here I will multiply with the 50. And then orders per year is not 18, orders per year is 10, I told you, right? Multiply by 10. So it means 15 times 50 times 10. Can you just multiply? Help me because I'm following the format. It will be easy for you. 15 times 50 times 10. Is that clear? No, unit cost is not 50, guys. This is unit stock out cost. We have to take it here. I'm making mistake here. Unit stock out cost is $5 only, not 50. Here we need to take units cost of stock out. So unit cost of stock out is 5. Go to the question and check. Unit stock out cost is given here $5. Sorry, this figure we have to take. Unit stock out cost. Read the column right here. Unit stock out cost is 5. So 15 times 5 times 10. Now just check how much it is. So 15 times 5 times 10, it is going to be 750. Okay, I got figure here 750. Okay, because look at the column. We need unit cost of stock out, which is 5. By mistake, I have taken purchase cost. No, not purchase cost. Unit stock out cost is given as 5. Okay, so 750 we got this one cost. Expected stock out cost, I got 750. You know, cost of carrying safety stock equals what? Expected stock out cost, expected stock out cost, which we calculated 750 plus carrying cost. Carrying cost we can calculate very simply, same way. Now carrying cost, how would you calculate? Carrying cost, you will write safety stock level, which is 100, because we are working for 100 only. And unit carrying cost, you have to check from the question how much is given. Unit carrying cost, we have calculated, maybe it was $10. Unit carrying cost was $10. We have calculated, which is 20% of $50, $10. So, okay. Unit carrying cost, which is $10 here. So 100 times 10, it will be 1000. Okay, I got second thing also. Carrying total carrying cost also 1000. Okay, so plus 1000. So this will be your cost of carrying safety stock 750 plus 1000 1750. This will be your answer. Okay, okay, D will be correct answer. Is that clear, guys? I hope so it is clear. Okay, now guys, I'm going to show you another question. See, this is also another question. So here we go. They're saying a company expects to use 48,000 gallons of paint per year, costing 12 per gallon. This is actually annual demand, and this is purchase cost. Inventory carrying cost is equal to 20% of purchase price. It means if you will take this is the purchase price, if you will take 20% of that, that is going to be your carrying cost. Company uses its inventory at constant rate. Okay, the lead time for the placing the order is 3 days. Okay, 3 days the lead times, and the company holds 24,000 gallons of paint as safety stock. Okay, this is safety stock is given 2,400 gallons. If the company orders 2,000 gallons, this is the order size of paint per order. What is the cost of carrying inventory? Okay, I'll apply normal formula now. You know, carrying cost per annum you have to calculate. I told you the formula is average inventory plus safety stock if safety stock is given. Okay, and multiply by holding cost per unit per annum. Okay, holding cost per unit per annum, he told you it's a 20% of purchase price. So purchase price is 12. So 12 times 20%, this will give you holding cost per unit per annum. Let's do it. So it will be 8, how much? 12 times 20% going to be 2.4, right? 2.4. And this we need to multiply with average inventory and safety stock. Safety stock is given as 2400 gallons. And average inventory, how you will calculate order size divided by 2. Order size is 2000 gallons divided by 2. So it means the answer will be, if first I will solve this, it's 1000 plus 2400 and multiply by 2.4. Okay, just solve it. If you will add this to it, is going to be 3400 times 2.4. This is going to be 8160 is going to be your carrying cost. Okay, see, actually, guys, look, it depends in the question data what they are asking you. In the first example, which I did, which was a bit complicated about carrying cost of increased inventory, right? That was different scenario. Here, I'm just calculating carrying cost only, just with the safety stock. Okay, and in this question, next we were having stock out cost. In this, we were having stock out cost. We were having carrying cost. Then how would you work? I have explained. Okay, now here we got another question. So look at the question they are saying. See, this is all about words now. They're saying carrying cost associated with inventory management include. Do you remember carrying cost? The list I told you, purchase cost is not your carrying cost. So this option is not there because he told you carrying cost. So purchase cost is different than carrying. So it's not the part of that. So this is incorrect. Storage cost, yes, it's carrying cost. Insurance cost, yes, it's carrying cost. Capital invested, even opportunity cost for that, yes. And obsolescence. What do you think? This is correct, I think. So all obsolescences, opportunity cost, insurance cost, storage. Yes, this is correct. Look at the C. This is all, these all are your carrying cost. Look at the C. Insurance cost, yes. Shipping cost, no. It is the part of purchase cost. So this is incorrect. Obsolescence, yes. Setup cost is the part of ordering cost. Do you remember I told you for internally manufactured inventory, setup cost equals ordering cost. Okay. Capital investment, yes, it is opportunity carrying cost. Purchase cost is also not carrying. So this is also not correct. Only B is the correct option, right? So see, the questions could be about what? Wording also. Okay, guys. I hope so it is clear. If you have any question, you can ask me. Thank you so much.